Good afternoon. Good afternoon, everyone. This is Bagadon, Stock Market Caddy, and it is Friday, July 8th. And before the day closes out, we wanted to demonstrate a couple of things for the benefit of our members as well as the benefit of our followers to give you an idea of some of the tools that are available and also to stimulate your ideas on different ways of trading. There's a lot of different ways to trade, and particularly when it comes to options. So what we're going to do right now is take a look at GLD, gold. This is the gold ETF. On a daily view, you're looking at the SMC, Stock Market Caddy Trade Generator, Pebble Beach triggers. Now it didn't generate a trigger, but that's okay. But what it is showing us, it's trading at 162.50, 162.50. And on a daily basis, it was in panic. It's coming out ever so slightly. Now, what I think is that gold near term is hitting a bit of a bottom. And I want to get long gold, GLD. Now, our account, we're going to try to do this proportionately. Don't want to get, too much of any one thing in our account. So we're going to pull up a trade button, and we're going to simply buy 100 shares of GLD at 162.50, which is going to be about 16,500. Let me show you. Okay, so what we're going to do is we're going to buy at market 100 shares of GLD, and the order is in. Okay, so, and we're thinking that gold is near term overdone, that it's likely to bounce, and that we could be moving into a market that I think is relatively flat, that I think will be on a longer term basis up. So we're going to do this hopefully every 35 or some odd days. So I'm now going to go to the TradeStation, and we want the TradeStation Option Pro, and let's take a peek together. Bear with me. Okay, so we previously, these are our positions, and we previously, under GLD, we had created a vertical call spread. Now, we're not going to talk about that here now, but this is the 100 shares, that we just purchased. So you come across, it's not an option, it's just shares. There's 16,250. Now, if gold goes to zero, not likely, we could lose 16,250. Our max profit is infinity. Our risk reward is infinity at this moment in time. Now, what we're going to do is we're going to sell a call against GLD, what is known as a covered call. It's a highly probable and fairly conservative step to take. In fact, it's the government allows you to do this in your IRA accounts. We're going to come to the option chain, and we're going to go find GLD. Here it is right here. We're going to click on it. And I want to go out about 35 days. So, and we're selling a covered call. So I want to sell a good amount of time, because time will be on our side. As the call that we sell decays, that money will hopefully accrue to us. So I'll explain in a moment the risk reward scenario of what could play out. But we come to the August 12th 35 day. It's trading at 162.50. If I go one strike, 163, 164, 165. Now, one of the things that could help us, this is going to be pretty good here. We could, let's go back here. We can look here. The trend axis which is about one standard deviation away from where we are right now, is at 170. So we'll come back, bring up the option chain again. So maybe we should start and take a peek at the 170. So if I sell, it is just about $1. And so we'll come up here, we'll go to the 167.50s. Okay. So what I'm going to do is we're going to come in here. We're not going to buy, we're going to sell, and we're going to sell one call. Click on that. I'm going to knock this down to just one. It's a short, so that's why it shows the minus. We're going to sell one call option for August 12th. It's a call. And we're going to put this in. I want this to go right in, so I'm going to change it to a market, but you want to use limit orders. And we're going to place the trade. And the trade is in. Now, I have 100 shares long. And let me kind of map this out. This is, bear with me, trying to get a drawing tool from. So we, right here, we bought, we're going to call it the GLD right here to signify that we bought it at 162.50. And when we buy something, we obviously have unlimited profits if it runs to the moon. But what we did was to sell, and I will put this in red, we sold a 167.50 right here. And the marketplace paid us, I'll write this down, they paid us $155, $1.55 a share, or, and I should probably do this in, I'll put it in yellow, $155 for that position. So what happens? If gold, and the date is August 12th. If on August 12th, at the close of business, gold runs to $200, our shares will get called away. Not our money, but the shares get called away. And what will happen is that'll generally be on a Friday. And on Monday, instead of having 100 shares of GLD, I'll have the value. And how much value will I have? Well, if down here at 16,000, at 162.50 is, we're going to do some math here together. If at 162.50 and we get called away at 167.50, so we minus 162.50, thereabouts, is $5. So we will have in our account $16,250 plus $500. We'll have $16,750 if we get called away. So if GLD does in fact run to 200, from this point on, I'm not going to make any money. Right? That's the trade-off. The person who bought the call option here, he's the one who will profit. But I get to keep his $155. So if this thing gets called away come August, at the end of business on August 12th, I'll have in my account not $16,250, but I'll have 16,905. And we can come back here and do the percentage return. Bear with me. So the percentage return is approximately 4%. So that'd be a beautiful thing. But what happens if come expiration, the shares are below 167.50, right in here? Well, what will happen is this. I'll still come on the 13th, I'll still own the shares at wherever they are. And I keep the 155 bucks. That's pretty cool. And I could turn it around, and I will, in another 30, 40 days, I'll do it again. But what happens, Don, if it goes below where I bought it? Well, it will go down. Just as if, you're along here. If it goes down, $2, we're going to be down a couple $100. But you also have a $155 credit here. So another way to look at this, and where this can help you to become more and more patient with your trading, and it's almost like having a dividend on steroid, the way I look at this, is your cost basis here when you buy the shares is what? 162, right? What was 162.50? That's what gave us the total amount per share. But we actually got $1.55 credit from selling the call here. So another way of looking at it is that it reduced our cost basis by $1.55, which would put it down in here. 162.50 minus $1.55, is what, around 161 or so, thereabouts, right? So that's another way of looking at it. That is a covered call. And what's neat about TradeStation is they will know what we did. So I'm going to click on this call. Now watch what I'm going to do. I'm going to click on it, and I'm going to drag it here, and I'm going to drop it on top of the equity position. And there it is. And it says, aha, I see what you did, Don. You have a covered call married to the stock. And it's August 12th. It's a 167.50 call, and it's 35 days. Now, we're not into flipping options. We're not trying to trade options or scalp options. We don't find them liquid enough. They're fairly costly. It's a little too much work. We'd rather do that with our futures. They're highly liquid. We can be more precise. But I want to, this is just a slow and steady way. If I'm rooting for something, it doesn't help to root. It's not a horse race, but it would be a beautiful thing. I actually want gold to run so that it just gets called away, and then I can repeat and do it again. That is how we go about picking a stock to buy, where we buy it, and then selling a call option. At what price do we sell it, and for how long? Now, I can break this apart. Let me give you, for instance, this call option right here. Okay, this is the credit, 155. If the trade does start to go against us during the time frame, this call option will actually begin to accrue more to us. Let's put it that way. So he paid us 155. If the price goes against this speculator, it's possible that I could buy back his call option, buy it back to close for just pennies on the dollar. And I just could close that out. I could close that out right now. I don't want to do that, but I could close it out, pennies on the dollar. Then if gold runs again, I could sell them another one and do it again. But this isn't something that we're going to be doing, every minute of every day. I have a block of money, maybe some retirement monies, and or some steady monies, and I simply just want to buy things when they've been discounted, where I think the market has hit a flat spot to up, and I want to go long, but I want to mitigate my risk a little bit by selling a call option against the stock I own and basically marrying it. So we'll erase this note here, and let's just show you once again. I think it's right behind here. No, it isn't. I'm sorry about that. Bear with me. And here it is. Okay, so we bought it because it was in panic sell. That's where we want to buy it. We bought the shares. We sold the call at 170. If it gets called away, beautiful. And we'll make 4% and on $16,000 in 35 days thereabouts, and we'll rinse and repeat and do it maybe with something else. And there's just a ton of, well, actually there aren't that many today in the panic sell column. And you can also do this with puts, but it's a lot easier with calls. I'm Bagadon at StockMarketCaddy.com. If you have any questions and like this approach to trading, like what you see, like some of the tools, you're welcome to give us a call, 813-758-8263. If you are an annual member, readily available, of course, every day. You can patch into the Zoom, of course, and monthly members, if you want to, send us any questions you might have, and or give us a shout. We're always available. Alrighty, have a great weekend, everyone. Covered call writing. We bought stock, went up about one or two strikes, just one or two strikes, out about 35 days, and sell a call option, and then just let it soak. Like a crab pot, let it soak. Good luck, everybody.